Thank you. All right, you have the floor. Thank you.
Well, thank you. Does this work? Everybody can hear me? I'm Pete Kyle, and I'm presenting this paper, Flow Trading. Thank you for inviting me to come here, and I appreciate the people who have stayed to the very last talk. The paper has 5 different authors, Eric Budish, Peter Cramton, myself, Mina Lee, and David Malec. And in some ways, as you will see, it's a kind of combination of things we've worked on in the past, plus some new ideas that we've put into this paper. So what are we trying to do here? What we're trying to do is propose a new way for conducting trading in financial assets. I'm going to use stocks as the example, or equity markets as the example from my discussion today, but it could be applied to futures contracts, foreign exchange, bonds, any other market. If you look at the way exchanges have traditionally functioned, or even dealer markets have traditionally functioned, traders will kind of submit what we would call a standard limit order. If I want to buy Apple, I might buy 1,000 shares of Apple by submitting an order to buy 1,000 shares of Apple at a price of $150 or better. The orders that traders submit are quite frequently orders for one stock, but the stock exchanges kind of trade stocks separately. They're priced one at a time in the order in which they arrive at the exchange. This, for some reason, is called a continuous limit order book, but it's one at a time processing of orders. And the display bids and offers, the highest price that a person is willing to, lowest price person is willing to sell at, and the highest price a person is willing to bid, those respect what's called a minimum tick size. That's regulated by the government, or in the past was regulated by the exchanges. Currently, it's 1 penny for the minimum tick size of prices and 100 shares for the display size of the quantity that you want to trade. This way of conducting trading, in my opinion, very obviously is a historical legacy of the time when trading was conducted by open outcry, and by humans conducting it face to face. And clearing and settlement and error correction all were done by hand with pencil and paper. You want to keep things simple, and so you needed something like this to make trading orderly and feasible. Now that we have computers, we don't need this anymore, but we still have it. It's a historical relic. But this historical relic that we have creates a market design which imposes some costs on traders that have been documented. First of all, there's the idea that an order can be picked off. If I put in an order to buy a stock at a price of 100, market conditions change, then I would like to cancel that order, because if anyone executes against it, I'll be trading at too high a price. I'll try to cancel the order, but a faster trader that we currently call high frequency trader probably has hit my bid, and I've already executed the order, and the high frequency trader has made a profit at my expense. So we call that being picked off. There's another speed related aspect of this, and that is when a new bid and a new offer price are going to be established, we have what's called time priority at many exchanges, which says that the order that was submitted first will be the order that gets executed first. That means if you're at the front of the queue of order execution, you're at an advantage relative to traders behind you in the queue. And so there's a race to be the first in the queue at the new offer when the price changes. That race will also be won by the fastest, and so high frequency traders make some of their money that way as well. Okay, another aspect of what's going on is that institutional investors who trade large quantities of equity want to trade gradually. They don't go in and just buy $100,000 all in one instantaneous transaction. What they typically do nowadays is split their 100,000 share order into maybe 1,000 orders of 100 shares each, execute these orders over time, maybe over a whole day or a week, depending on the liquidity of the market. And that's something that's rather difficult to implement, because you have to place not just 1,000 orders, but perhaps many thousand more, because you're adjusting prices and not all the orders get filled. And then finally, if you want to conduct arbitrage trading between different markets, for example, between Apple and Amazon, you're buying Apple, you're selling Amazon. As the price of one changes, you have to place and cancel orders in both of these different stocks. And that requires a complex algorithmic strategy and their costs of bandwidth and costs of programming and so forth that arise in doing that. So this historical design creates these costs. So what do we propose? We're proposing a combination of 3 ideas to deal with this and to reduce the costs of trading so that institutional investors and retail investors alike basically have an easier time of it. So the first ingredient in our proposal is what we call flow orders. And that is, instead of submitting orders that, if you drew the graph of the function, would look like a bunch of dots that sketch out a step function. Instead, you submit a piecewise linear downward sloping curve for a continuous price and a continuous quantity. Okay, well, in contrast to a lot of the research that was being reported at this conference, securities markets are different because securities are essentially infinitely divisible, right? And other things like kidneys and heart transplants, things like that are not infinitely divisible, or foster parents, you know, but in the stock markets, stocks are infinitely divisible. And the idea of trading a fraction, even of a share, makes quite good sense. So when you do this, you solve some of the many of the problems that exist in current markets. Jeongmin Lee and I have a paper about this. So what you do is you submit an order that says, I would like to buy 1 share per second until 1,000 shares have been executed. That's making it continuous in time, kind of dividing it up across time. And you also submit a range of prices that allow you to adjust the quantity that you're buying up to a share a second. Maybe it's 0, maybe it's a share, maybe it's some other fraction in between. Okay, that's the first idea. The second idea is frequent batch auctions. That's been proposed by Eric Budish and Peter Cramton, 2 of the co-authors in this paper, as well as Shem. And they propose having auctions at discrete intervals of time where bunch of different orders are processed at the same time. And they argue that reduces the advantages of speed by kind of creating a more level playing field between the fastest traders and the slowest traders. It doesn't do it perfectly, but it does do it quite well. And then the third point is new in this paper, and that is we're proposing that traders submit orders to trade portfolios, not orders to trade individual securities. And we define a portfolio as a linear combination of assets. So you could submit, your portfolio could be to just buy Google. Your portfolio could be to just sell Google, which we implement as buying a negative quantity of Google. Your portfolio could be to simultaneously buy Google and sell Amazon. So there'd be weights of +1 and -1. And I'm gonna assume, just for the sake of discussion, that the universe of assets has 500 stocks in it. So that could be implemented with a portfolio that has a +1 and a -1 and 2 parts of the portfolio and zeros everywhere else. But you could submit an order for the whole S&P 500, which would have various weights for all the different stocks in the S&P 500. Some stocks are big weights, some stocks are little weights. If the weights in the order have the same sign, that essentially makes the stocks complements, if you think about it the way an economist thinks about it. If it's opposite signs, like a pairs trade where you're buying one and selling another, that makes the assets substitutes. So we allow both complements and substitutes. Now, the big assumption that we make is that your portfolio that you have to submit is a downward sloping function of the price of that portfolio itself. Okay, this turns out to be the critical assumption that drives everything that we do, and you'll see why by the time we get to the end of the paper. So there's a summary of the 3 different things that I just said. So this design is going to create several benefits related to the problems that I summarized at the beginning of the talk, that the investors can express lots of different strategies in a very simple language and sort of very easily implement things that would otherwise be very cumbersome to implement. It reduces the ability of pure speed to generate rents for itself, and it also reduces the cost of the rent seeking that goes along with the generation of those rents. It makes it easier to provide liquidity across multiple assets. So a lot of times these assets are stocks of close substitutes. And so providing liquidity across assets can be quite important. If they take Berkshire Hathaway stock, there are 2 different versions of it that trade. They're basically identical. So they should have prices that are related by a linear formula. This makes implementing that very easy. And finally, it may not be obvious to you, but if you think about it, there's an issue of transparency and fairness. In the current market design, is typically the case that the market clearing price is such that either they're either buyers or sellers who are rationed at that price. So they're people that wish they got their order filled, but they didn't because they were bidding or offering exactly the price, but the quantity bid and the quantity offered didn't actually match just because of the discreteness in the market. And that means that if you're looking at prices on the ticker tape, you can't tell whether your order got executed or not. So the market trades through your order. But in our design, you can. The price, if you see the price on the screen, you've got a downward sloping demand schedule that's strictly downward sloping. You can calculate exactly the quantity that you should have traded, and it makes the market kind of more trustworthy, more transparent, and fair from the perspective of the traders. Now, we're not fixing everything that's kind of what economists would call a market failure in the financial markets. Indeed, we're not addressing the traditional market failures that exist that are related to adverse selection or related to market power. We're not doing that at all. So we're expecting that the participants in the market will still shade their bids. They'll still stretch their trading out over time. They will trade strategically the way they used to. But there will be a kind of a more less costly interface into the market that would save millions of dollars, potentially, maybe billions. Yes.
So I understand the motivation for each of the features of the design. Is there a sense in which they're complementary to each other?
There is a sense in which they complement each other, because when we get to the end, we're going to see, you actually have to calculate the market clearing prices, and the calculation problem is non-trivial. And so this infinite divisibility that prevents it from being a discrete problem is one of our aspects of our design comes into play. And also, it takes some time to do the calculations. So as a practical matter, you need to have discrete frequent batch auctions, because you can't do it instantaneously in continuous time. So in that sense, they're all tied together by the three assumptions all tie themselves together. Okay. So our contribution, this is what this slide says, is our contribution, it's not to do anything that looks revolutionary in and of itself, but it's to take a bunch of ingredients that you probably have got in your pantry somewhere and put them together in a different way to create something that's perhaps non-obvious and works. But we do have some technical results to show you, and we've got some existence and uniqueness results. We've got what we call a computational proof of concept, and I want to talk a little bit about the micro foundations of our approach. Okay, so there's a literature, pretty big literature on market microstructure. I already mentioned there's my paper with Mina Lee and the Budish, Cramton, Shim paper, but there's some theoretical work that motivates the idea that institutional investors want to trade gradually over time if they're trading one asset. And this idea would obviously generalize to portfolios. The first nice paper on this was Vianos 1999. And then Du and Zhu and then Anna Bajaiva, Yajun Wang, and I have a paper that kind of develops this idea in an environment, all these papers in an environment where traders are optimizing. They can trade in a dynamic situation. They're adjusting their inventories, they're risk averse. There's almost perfect optimization going on that respects Bayes' law. And what comes out of it is the idea that you exercise your market power, you trade strategically by trading gradually over time. Okay, then there's some other papers that are related to this as well. There's one set of literature that looks at sort of sophisticated expression preferences over a wide range of multiple objects. We're kind of running orthogonal to this. And then this is what Milena talked about. And also Marzena Rostek has papers that are related to discussing whether you clear assets jointly or clear assets separately, what are the welfare consequences of that. That's an interesting area of research. It's kind of different from what we're working on. And then there's another aspect of the literature that's also a bit orthogonal to what we're doing, and that is that kind of says, because of adverse selection and so forth, markets don't have enough liquidity. How can we rejigger the rules of the auction so that we create more liquidity than the market would kind of naturally create? And so the paper by Duffy and Zhu and some of these others address it that way. And then finally, we're running kind of orthogonal to the literature that talks about indivisible goods. We're making the goods divisible. And by making them divisible, we get some analytical tractability, and the analytical tractability, I think, allows our proposal to be feasible. So let me talk about how the orders work and then get to the result. Well, when you submit an order, your order is first defined by the portfolio you want to trade. We call that W, put it in bold because it's a vector of 500 portfolio weights that are kind of arbitrary. Not that if it's a positive, it means you're buying. If it's negative, it means you're selling. And you can have arbitrary combinations of positives and negatives in your order. You then submit what is like a limit price, except that we have two limit prices, PL and PH. PH is the price at which you start buying the portfolio. At any price above that, it's too expensive. You don't want to buy any. PL is the price at which you buy the maximum quantity that you're willing to buy, which we specify as a rate, which is Q, be like 1 share per second, or excuse me, 1 unit of your portfolio per second. And in between, you prorate the rate at which you buy linearly, and that makes it a piecewise linear demand schedule. And then, so you've got W, the two limit prices, and the maximum rate. Those are the main elements of describing how your order is going to behave at the next auction. But then there's other information you can put in, and we call it Q max, the cumulative quantity you want to buy. Maybe you want to buy 10,000 shares, but you want to do it at the rate of 1 share per second. So it's going to take 3 hours, approximately, even under good circumstances, to get that order executed. Okay.
Is PL and PH indexed by time or not?
PH and PL just have units of dollars per share. And the auctions are taking place, let's call it once per second. And then capital Q max is the total amount you want to buy. And Q, a little q, is the maximum number of portfolio units you want to buy at any one auction. And so your order carries over from one auction to the next. If capital Q started at 10,000 shares, it goes into the first auction. If you bought 1 share, then the capital Q that goes into the next auction is 9,999. And then capital Q works its way down to 0.
They all have to be between PH and PL.
That's what?
They all have to be between PH and PL, or I don't buy.
The Q's above PH, the quantity you trade is 0. We call that X. Below PL, the quantity you trade is Q. That's the maximum. And then in between, it's linearly prorated. Okay. The way we implement selling is we think of selling as buying a portfolio, buying a negative quantity. But then we think of the price as being negative because the price is the value of that portfolio that has negative quantities in it. That's the same convention that's used in general equilibrium theory, which thinks of selling as a downward sloping demand schedule for a negative quantity. Okay, so how do the orders work? They execute at the maximum rate if the price is below PL, at 0 rate if it's above PH, and linearly in between. So each order represents a piecewise linear downward sloping demand schedule with one segment that's downward sloping, but you could see that a whole bunch of different orders and kind of sketch out anything that approximate a downward sloping demand schedule that's kind of arbitrarily continuous. So I think I'm going to skip the rest of the slide because I've already talked about it. So you can write this down as math, but let me emphasize the difference between the portfolio price, the price of your portfolio that you're trading, that's the PI, and the market prices for the assets in the market. That's going to be what we call pi, a vector of prices for the assets. So if the vector of market prices pi is given to you, you can take the inner product of your portfolio weights, W, and that pi, and get a price or value for your portfolio. And then you can put that into the demand function I just described and calculate the quantity you want to buy. We call that XI, okay? And you can do that for every order in the market. When you do it for every order in the market, I'm going to skip this slide. Let me just say, this is not an unlimited language that can let you express arbitrary preferences for anything. There's some limitations here, but it's pretty flexible and it expresses many of the types of demands that asset managers really want to express. Pairs, trades, substitutes, complements, urgency. You can approximate an arbitrary continuous downward sloping demand schedule. You can do it for kind of arbitrary portfolios defined as linear combinations, but you can't do anything. And the things that you can do, many asset managers do in fact do. So we think we're addressing uses that would actually be the asset managers would find very practical. But there's some limitations. You can't have you have to have a downward sloping demand schedule. It has to be a linear combination, not a nonlinear combination. The language doesn't allow for indivisibilities. We think that's kind of irrational anyway in an asset pricing context. And the price of at which the demand as a function of the price of the portfolio has to be a function of the price of the portfolio you're trading, not a function of the price of something else. I can't buy Apple if the price of Google goes up. I put that into my demand schedule. If I'm buying Apple, it has to be a function of the price of Apple. There are some limitations. Okay, so let me go to market clearing. The way market clearing works is that the exchange is trying to,
Yeah, before you do that, to what extent could you get a computer or a program trader to pretty much mimic the kinds of orders that you want to put in? I'm not talking about the market clearing, because I realize the market clearing is going to be a different mechanism because you've got these sort of sequence of options. But in terms of the orders themselves, couldn't most of the stuff that you've described be executable?
Well, I think the answer to your question, if I understood it correctly, is certainly asset managers, arbitrageurs, various market participants are doing strategies that could be implemented with our proposal. And they can do it pretty well, and it costs a lot of money. It's very expensive. So consider, for example, arbitrage against the S&P 500. I can place 500 orders for 500 different stocks and adjusting every 1/10 of a second throughout the day to make sure that it all adds up to the price of the S&P 500. I need a gigantic database. I need a lot of complex software. I need a lot of ability to handle messages. And so I need a lot of complicated technology to implement that. And the traders in Wall Street have invested in this complicated technology. It's very expensive. And so what we're doing is saying, let's just, instead of make it require complicated technology that's very expensive, let's just let it be implemented with one little command.
Yeah.
And so we're making it easy to implement the things that traders already do implement. And they would say they already implement it fine, but they don't want their hundreds of millions of dollars of investments in technology to be perhaps eroded in value by our proposal that is a technological advance over what they're doing right now.
Yeah, I understand.
Okay.
And I assume that when people are trying to buy up large shares, well, I don't assume, I don't, but people are trying to buy up controlling interests in firms, they do exactly the sort of thing that you're describing so that the price won't adjust too much.
Yeah. A good example of that is Warren Buffett buying shares in Apple or Chevron or whatever company he's interested in. He doesn't go in and buy half the company in one day, right? He will buy, hundreds of or tens of thousands of shares, but maybe scattered over time over months and months and months, gradually accumulating a position that's big. And he's accumulating over months and months and months to strategically reduce his market impact costs. And that's the essence of these papers that I was describing that address that issue. Okay, back to market clearing. The problem for the exchange is going to be to calculate the prices for assets, not really the prices for portfolios, but the prices for assets that clear the market. So if I want to buy Apple and sell Google, I don't have to trade with somebody else who wants to buy Apple, sell Apple and buy Google. I can trade with two separate people, one of them who wants to buy or sell Apple and the other one wants to buy or sell Google. And then the exchange can kind of put it all together so it clears. So the exchange tries to find prices pi such that when you calculate, I calculate the demand for my portfolio, that's the capital D that you see in equation 3. That's a scalar quantity that's a function of the value of my portfolio calculated at those market prices, the inner product of pi and W. That gives me the number of units in my portfolio I want to buy. But since the market is going to clear in the assets, I have to scalar product that with the vector of weights, asset weights in my portfolio. That's what you see in equation 3. And then that gives me my demand for assets. It's a 500 by 1 vector. And then we have to sum that up across all 100,000 or million orders in the market. And that will give me the aggregate demand as a function of that vector of prices pi. And the problem for the exchange is to find the market clearing price vector pi. So that involves solving 500 equations and 500 unknowns. And the equations are defined by the 100,000 or million orders that exist in the system for all these various portfolios. Now, once the market clearing prices have been found, which is market clearing prices defined by equation 4, each trader in the market can calculate how much his order executed by taking those prices and putting them into his demand function. Okay, so this is just an illustration of downward sloping demand functions. So we've got here a couple of questions. We've got an existence question. Do equilibrium prices and quantities exist? And if so, are they unique? Let me ask John, how much time do I have?
You have about 25 minutes.
Okay, thank you. So first question we're going to ask is questions about existence and uniqueness. And how do we do this? And keeping in mind, general equilibrium theory says this should be an impossibly difficult problem and we're in a hopeless situation. But we've made some simplifying assumptions that turn out to be very useful. We're going to pretend like these orders came from some preferences. And then we're going to attribute to each order a utility function. And then we're going to look at the optimization problem of maximizing the sum of the utilities across all the traders in the market. And we're going, if we can solve that maximization problem, we're going to interpret the Lagrange multipliers associated with that maximization problem as the market clearing pricing. So it turns out that strategy works quite nicely. And the next slide explains why it is so nice. So the first point is, since the demand schedules are piecewise linear, when you integrate them and turn it into a utility function, it's a utility function that's quadratic in that region where you're trading a quantity between 0 and Q. But if you're outside the limits on your limit order, your quantities are constant, either 0 or Q, and therefore when you integrate it, it's linear. So you've got two linear pieces that are pasted together with a quadratic piece, but the restrictions on your order require essentially that you're going to be on that quadratic piece. So we essentially have quadratic utility functions, and that makes things easy. Okay, now we're going to maximize the sum of these quadratic utility functions. That's equation 7, subject to some constraints. Constraint number 1 is the market clearing constraint. So 500 markets have to clear simultaneously. And then number 2 are the constraints on the order that say the quantity you trade can't be less than 0, and quantity in terms of portfolio units can't be less than 0, and it can't be greater than Q, the number of portfolio units that was the maximum on your order. So when you put all this together, what do you get? You get what an OR researcher would call a standard quadratic programming problem of maximizing a quadratic objective subject to some linear constraints and also some nonlinear constraints, but they're both linear, they're all, some linear equality constraints and some linear inequality constraints, okay? Not only is this a sort of standard form quadratic programming problem, but it's a quadratic programming problem that has some very nice properties. The first property is, if you look down at the equation at the bottom of the slide, is that there's a matrix D. Well, it turns out the matrix D is a diagonal matrix of strictly positive elements. It's sort of telling you essentially the slope of your demand schedule that you're submitting. And if there are 100,000 orders in the system, it's 100,000 by 100,000 matrix of slopes along the diagonal and 0 everywhere else. So that's a nice matrix to have if you're trying to solve a quadratic programming problem. Very nice indeed. The second nice property that this problem has is that if you look at the inequality constraints, not only are they linear, they're kind of box constraints. It's not 0 less than AX less than Q, or A is some arbitrary matrix, 0 less than X less than Q. So this makes it a very simplistic, what they call separable quadratic programming problem. And so there's some hope that we can actually solve it. But let's first look at the theory. The theory says there exists a unique quantity vector X, which does solve this minimization problem. And we've got a couple of other assumptions that we've made that have made this possible. The way it's set up, it's a compact problem. But the other assumption we've made is feasibility. Every order could trade a quantity of 0. You know, that's a possible outcome. If every order trades a quantity of 0, the net demand is 0. Well, guess what? The market clears. So market clearing is feasible. And that turns out to be an important assumption in theory that allows us to conclude that we've got existence here. The objective function is strictly concave because the only part of the objective function that's relevant is that quadratic part. Quadratic function is strictly concave. That gives us uniqueness of the market clearing quantity. Okay, so it's just pretty trivial and it's pretty standard result in optimization that you have unique market clearing quantities that solve this problem. But we're economists, right? Let me just say before I go on, the fact that we've assumed the goods are infinitely divisible, and the fact that we've assumed the schedules are downward sloping has given us this strict concavity and the continuity properties that allow us to get the solution. Yeah.
Would these properties for the utility function if you did a frequent batch auction and it was possible for participants to express complex strategies in the way that Bob was suggesting, would you get back the same equilibrium as being unique?
I couldn't quite understand your question.
Let's say that you had a frequent batch auction instead of this type of trading mechanism.
Yeah.
And the participants could express or could execute the kinds of strategies that Paul was suggesting. Like they can, in that case, would you get back to the same equilibrium with these primitives?
Oh, I'm not 100% sure of the answer to that question, but I suspect that the answer is that if you had a 500 separate markets and dynamic trading in these 500 separate markets, that you would get back to the same equilibrium. But we're not really talking about an equilibrium in this paper. We were talking about it in some of the other papers that I talked about. But I'm quite confident that it would implement the same equilibrium. It's just that the amount of technological bandwidth, programming, people, technology would be a lot less. It'd be cheap to do it our way. In that sense, more efficient, kind of operationally more efficient. Okay, so we've got these assumptions that make it easy to get the answer. But we're economists, so the way an economist is likely to think about this is, let's think about it in terms of prices, not in terms of optimal quantities. But that's the dual problem that's associated with this quadratic programming problem. And you can write down the Lagrangian. You can try to look at the dual problem, which is the problem of solving for prices. The maximization problem becomes a minimization problem, like an expenditure function in consumer theory. And the problem then is to choose prices that solve the dual optimization problem. And when you do it that way, you get theorem 2, which says there is at least one optimal solution, meaning one set of prices, which solves the problem, gives you the same market clearing quantities, and that at least one vector of prices gives you exactly the same value for the optimization problem. So they're a primal, what they call a primal dual pair in optimization theory. What you don't get out of this theorem is unique prices. Obviously, prices cannot be unique because if there's only one order in the market, zero trade is going to be the equilibrium because there's nobody for that order to trade with. But any price that's above the pH is going to clear the market. Convex set prices, in this case, unbounded as well. And so you're never going to get unique prices. Okay? That's going to be a problem we're going to talk about in a second. So now let me turn to the second issue. And the second issue is computation. So we've got existence. We don't have unique prices, but we've got unique quantities. Can we compute these fast enough so that it would be feasible to have frequent batch auctions on a relatively frequent basis? And we're picking once per second as our benchmark to try to hit. So that means, can you solve this quadratic programming problem with 500 market equality constraints? And if there are 200,000 orders, 200,000 inequality constraints, can you solve that problem in less than a second? And we want to claim that you can, but I just want to observe that before we claim that you can, a lot of the intuition that you would have derived from thinking about economic theory is going to be wrong. So first of all, the work of Mascalel and Scarf and so forth would suggest that market clearing price, solving for market clearing prices is very difficult. It's going to have to be pretty easy for us to solve it in a second. The second direction that turns out to also be wrong is that an economist would be likely to use a Walrasian Tâtonnement type algorithm. Let's take prices, and if there's excess demand, we will change the prices one way. If there's excess supply, we'll change prices the other way, trying to reduce the amount of excess demand and supply and get towards zero. Well, in optimization theory, the Valoresian tâtonnement turns out to be essentially equivalent to the gradient method. And the gradient method works horribly on this particular problem. One of the reasons that it's a very bad algorithm for this particular problem is there may not be much liquidity. There may not be any orders at all for certain assets. And so the gradient method doesn't really know what to do to find market clearing prices. So what we want to do is go in a different direction. But we could go in this direction of defining a gains function, which is related to the dual problem of maximizing the welfare associated with a given set of prices by imputing the utilities to the people placing the orders. That strategy works. It's just that it's going to take a long time. So the gradient method could be used. It could get the right answer, but it's not going to be practical to use it in a second. And there's a theorem here that we allude to that just says that it can work, but it doesn't necessarily work very well. So what are we going to do? We're going to use a different optimization method that's fairly common nowadays. That's an interior point method. But an interior point method, it kind of doesn't have to have, but it's good for an interior point method to have an interior point. Well, an interior point is related to what economists call a non-empty interior assumption that you get in general equilibrium theory. But in our case, it shows up in a very intuitive way, and that is that no trade is feasible, but it's not quite an interior point. No trade is sitting on the boundary of the set that it needs to be on the interior of. So how do we get it how do we get no trade to be an interior point? And the answer to that question is, we'll let the exchange be a market maker that supplies just a little liquidity in every asset. So the exchange will submit a downward sloping demand schedule to buy very, very, very tiny amounts of every asset in the market. Well, what does that do? Well, that makes no trade an interior point, or at least I can move a little bit away from no trade. Then on each order, give it a small fraction of the order that's being filled, let the exchange take the other side of that, and now it's an interior point. So we can find a starting point to get our algorithm going, and we can take advantage of theorems about interior points. And hopefully it's not going to cost us very much in the sense that the exchange is not going to have to actually put a lot of capital on the table to make this happen. So the way the interior point method, the way the interior point methods work is that you take the inequality constraints and you kind of put a log function on them. I use the log function as a penalty function. So it's no longer a strict constraint, but it's kind of a penalty function. And then you have a coefficient that's eta bar, nu bar, excuse me, in this equation 19. And you make nu bar really, really small. So the penalty is really small, but the shape of the function, it's a log penalty function. The shape of the log penalty function is enforcing your inequality constraints for you, even if nu bar is really, really small. And so then you solve the problem with very, very smaller and smaller and smaller values in nu bar. And that gives you a very close approximation to the actual solution of the problem you're looking for. So that's how the interior point methods work. And there's some theorems that say that they can converge potentially pretty quickly, but I found that the theoretical theorems aren't what's useful. What's useful is the practical results. The practical results are the interior point methods work very, very well, and they do better than gradient methods. So to make the interior point method work, we need to solve a system of equations that are kind of related to the Kuhn-Tucker conditions. So you have the Kuhn-Tucker conditions for the original problem that basically are the first order conditions plus all the constraints plus a complementary slackness condition. The interior point method essentially changes the complementary slackness condition to being not something equal to 0, but something equal to nu bar. That makes it a nonlinear problem because the mu and the x's you're solving for both simultaneously. You're solving for the multipliers and for the quantities simultaneously. But you have this system of equations that's got a little bit of nonlinearity in it that you're trying to solve. And so what do? We just take a standard off-the-shelf algorithm. There's a CDX opt as a package that I think it started out in MATLAB and it's also in Python. We didn't actually use that package. I actually took a look at the algorithm and then translated the algorithm myself to get my own version of that algorithm. It's ever so slightly different, but it's basically the same algorithm. And you linearize this slightly nonlinear system, and then you solve the linearized system. Then you use that to get a search direction. Then you go in that direction, but you make sure you don't go so far that you violate any of the inequality constraints. So you have to truncate your guess, and then you repeat that a bunch of times, and you find that you converge very quickly to an equilibrium. The way I actually implemented it is you don't want to solve, you don't want to like invert a 100,000 by 2,000 matrix, but 500 by 500 that you can do. And so it's easy to go from the 100,000 by 100,000 to the 500 by 500 because that D matrix I talked about is diagonal, so it's a trivial conversion. And when you get it down to a problem of prices, what's your price direction, you need to invert the 500 by 500 matrix. You can use the Cholesky decomposition for that. Turns out to be pretty efficient. It requires that the matrix be positive definite. But guess what? We put the exchange in as a little bit of a trader for every single asset. And in addition to giving us kind of unique prices and giving us the interior point, that's going to also give us the Cholesky decomposition that we need to make the algorithm work. Okay, so what we did is I tried to put together a really badly behaved difficult problem that had a lot of stocks that didn't have any orders, and then other stocks that had gigantic orders, to try to make it difficult to solve. But using as a benchmark 500,000 assets and 100,000 orders. Now I made my life a little bit easy by limiting the number of arbitrary portfolios that traders could trade. You just gave them a kind of a menu, a kind of smallish menu of market trade portfolios that included market portfolios and what we call industry portfolios and size portfolios that they could trade, and then randomly generated orders. And then took the random orders, 100,000 orders, let's say, try to solve the problem and see how long it takes our algorithm to solve the problem. And this is the result that we got. So the base case scenario is 500 assets and 100,000 orders. What the first picture shows is what happens when you have 500 assets, but you allow the number of orders to vary all over the place. And what you can see is that up until about 100,000 orders, it's taking on the order of approximately 1/10 of a second to solve the problem. So we're well under our second. But you can go all the way up to over 1 million orders, even up to almost 2 million before you hit the 1 second mark. So you can solve big problems fairly quickly. On the other second picture that you're looking at, we hold a number of orders constant at 100,000 and vary the number of assets. Well, here what's going on is our Cholesky decomposition is an n-cubed algorithm. So every time you double the number of orders of the Cholesky decomposition, but you have to do one every iteration. So you're doing it many, many times, like maybe 35 times or something. It starts taking a lot of time, and you see the time explode. But the number of assets can get up over 1,000, maybe about 2,000 assets before you're getting up to a second.
Seems like all these, I can interrupt, all these algorithms seem serial, and speed is, seems like the way you're describing these algorithms is that they're serial algorithms. One iteration after another.
Yeah, they don't, a lot of it doesn't parallelize very well.
Yeah,
because
that's the way you should be aiming for, right? So if the goal is to get it under, to have these things execute quickly.
Yeah, you would like to parallelize everything, but it's hard to parallelize these things. And in the optimization algorithm itself, each iteration requires the results of the previous iteration. So you can't parallelize that very well. And then within each iteration, you're doing things like Cholesky decomposition. Well, that doesn't parallelize very well. I found that a lot of the mathematical operations you do are actually element by element multiplies, adds, subtracts. NumPy, I was implementing it in Python. NumPy actually does not use multiple processors for the element by element operations, but I implemented the whole thing in PyTorch, which actually does, and made it actually much faster than implementing it in NumPy. So that's what we did. But we think that the key to making it faster is actually to use a faster chip, because it doesn't parallelize particularly well. We tested it, using multiple cores doesn't help. Using 2 cores is you get about as much advantage from parallelization as you would for anything else. Okay, let me keep on going. So, we've added the exchange as a trader, and I said, I hope that the exchange didn't have to put too much capital on the table. And the answer is that in the simulations that we did, if the trading volume is $10 million a second, the exchange is trading less than $1 worth of stock. And that means like the sum of all the volume that it's doing across all 500 stocks is less than $1. So it's like trading less than a penny in each of these stocks. We view that as trivial, but you're getting a lot of mileage from it. You're getting the theoretical uses of the interior point method. You're getting prices to be essentially unique, and you're getting the Cholesky decomposition to generally not crash. If it crashes, you can let the exchange trade a little bit more, and this is how much it needed to trade to prevent the Cholesky decomposition from crashing. So now let me finish up by talking. How much time do I have? Any time left?
Yeah.
Let me talk about. So we think we've established kind of the computational feasibility of it. And let me mention one other issue, and that is a kind of practical use case that I think illustrates the intuition for what's going on in our model here. So let's look at a typical portfolio demand on a static. Admittedly, this is a static one. The other papers I've talked about make it dynamic. Let's look at exponential utility. I'm a trader. I've got some means, I've got some variances, I've got exponential utility, and I want to calculate my optimal demand. Well, my optimal demand is equation 28. I put my means in the numerator. For one asset, I would be dividing by the variance, but here I'm pre-multiplying by the inverse of the covariance matrix. I'm multiplying it by the inverse of my risk aversion, because the more risk averse I am, the less I'm going to trade, and I get my optimal quantity that I want to demand. And now there's a problem here, but it's only an apparent problem. That's what I want to show you why. The apparent problem here is the quantities that I want to trade of Google stock seem to be a kind of arbitrary function going through this inverse of the covariance matrix, a kind of arbitrary function of like all the other stocks in the market. But we're requiring that the portfolios that I trade the quantity of the portfolio I demand has to be a function of the price of the portfolio itself. So it looks like when we look at equation 28, we're not getting that. Well, it turns out that that's not going to be such a big issue, because I can take that covariance matrix, which is positive definite, and that's of course the whole point, and it's got a minus sign in front of it, so that makes that goes along with the demand schedule being downward sloping. And since it's positive definite, I can calculate a singular value decomposition, and the singular value decomposition has the form 29. And this delta matrix in the middle is going to be a diagonal matrix with all positive elements. So I can take the reciprocal of the diagonal elements and get the inverse of the matrix. And then I can kind of re-express my demand function in terms of the matrix U, which is an orthogonal matrix that I kind of used as part of the singular value decomposition. Recall the singular value decomposition says 29. I can take an orthogonal matrix U and write my arbitrary positive definite covariance matrix sigma in that form. And then when I do that, I wind up with 31. And what's going on is the U matrix is essentially rotating all the assets, but it's rotating them in exactly the way that creates a series of portfolios such that my portfolio demand for each portfolio is a function of the price of exactly that portfolio. So it's singular value decomposition is putting the problem in exactly the form we want. So that's a nice result. And the second nice result that goes along with it is in a lot of cases, asset managers are looking to limit price impact. Well, the price impact matrix is another positive definite matrix. And it turns out when you put price impact into the exponential utility problem, you're just adding the covariance matrix that's multiplied by the risk aversion to this price impact matrix. So it's still a positive definite matrix. So that doesn't change the fact that you get a nice singular value decomposition and you put it in exactly the form we need for our results to go through. So we can handle price impact, we can handle exponential utility. You might ask, well, what can't we handle? And the answer is there are two important things we cannot handle that are just limitations of the approach, and obviously not going to go away very easily. One is we can't handle wealth effects. Exponential utility doesn't have income effects, but if you have income effects, you get backward bending supply schedules, demand schedules don't slow down anymore. You're dead as far as our approach is concerned. And the second thing you can't implement is learning from prices, like in a rational expectations equilibrium, because learning from prices might also not be monotonic, and therefore, might get things going the wrong way. There's a slide here I'll discuss, skip. So there's some policy issues here. We think it makes the market more operationally efficient. It allows traders to compete more easily. It makes the market more fair in the sense that you can infer exactly from prices. The quantities that you get executed is very transparent, and therefore it creates some trust in the market. There's some other issues that we don't do a lot of in the paper that relate to what happens if prices aren't unique, or we added exchanges and liquidity provider. What happens if you can't calculate the prices fast enough? Or we think, well, probably you can just let the exchange pick up the unclear quantities. How much transparency do you want? That's a long discussion I'm not going to go into here, but market microstructure people talk about pre-trade and post-trade transparency. So to conclude, we've introduced this new market design that's based on trading portfolios and extending the previous work of the authors on this paper, and showing that we think it's a feasible way to conduct trading, and it's something that we should consider. So I'll stop here.
I want everyone who needs to catch an airplane or they feel free, but we'll just open it up for some questions. Anyone who needs to leave, you're welcome. But thank you again for coming. But let's open it up for questions.
Yeah.
How much would it take investment capital to start up an exchange? Would it be like hundreds of millions or?
I think the technological cost of setting up all the software would probably be zero, because you can do it on the software. You could do it with the hardware that you already have. It's going to use less hardware because current exchanges need to process all these messages. And we think that the way we would implement things, there would be so many fewer messages that it would take less in the way of hardware resources. It would take some software resources, but where we think the big costs are is in the regulatory hurdles. So and it's not that I think the regulators would actually like this approach, because it implements the goals that the U.S. Securities and Exchange Commission has for financial markets, of promoting competition and efficiency and trust and fairness, things like that. Exactly what's in the law. But the way regulation works is it contemplates a tick size of a penny. It requires bids and offers to be exposed to the market in a kind of pre-trade transparency way. Our natural way of implementing it is not going to expose a bid-ask spread. So you would need either to change the regulations, or you would need to implement it as what market microstructure researchers call dark pool, which is not really as an exchange, but as a sort of side market to the exchanges. But the problem with dark pools is that they're supposed to trade within the current bid and offer offered by the exchanges. And we would anticipate that there would be a lot of price discovery taking place in our market if it were successful and had a lot of trading volume. And so that would mean that if there were shock to the market, the prices should move outside of the bids and offers quoted by the other exchanges. They should be following our design. So we think the hurdles are regulatory, and that the costs are going to be low other than these regulatory hurdles. And the other kind of cost actually is changing let's say the trading systems now are evolved around messages having a certain format. Well, we've got a few extra ingredients like the pH and the PL, not just one P, and we've got our maximum rates, not that big of a problem, but it's something that would have to be dealt with. So the message formats might have to change, things like that. So I think there are some regulatory and institutional constraints that you need to get over. But once you get over those, you're saving a lot of money. It's an efficient way to run the market. Any other questions? Comments?
Well, there was this Arizona thing, so maybe you could run it, or there's this IEX that's slowing down trades, right?
Yeah, so there,
Convince IEX to try to run this,
yeah, I think that the right way to go would be to go to an entity like IEX and say, okay, you're trying to implement IEX, by the way, for those of you who don't know, it's a kind of exchange or dark pool, but it's a, you can think of it as a market design that is trying to reduce the rents that high frequency traders get just from being just from being fast, but not reduce the rents they get from being a market maker. You know, if you're providing liquidity, that should be fine, but you don't want a kind of zero sum, well, negative sum costly race for speed that doesn't intrinsically generate any efficiency gains for the economy as a whole. So their idea was to try to use some nice little tricks to prevent the high frequency traders from having an advantage relative to everybody else. And there are two basic strategies that could be used. One is to shuffle the orders. There's the order in which they actually arrive that's based on speed. But if you put them into a kind of waiting room and then randomly pull them out of the waiting room, that kind of reduces the advantage of speed. That's one way to do it. And another way to do it is just to delay some of the orders, which I think is the way IEX was doing it. They did it by putting it through a fiber optic cable. Very long, and at the speed of light, so things down by maybe a microsecond or something. That's one way to do it. And our approach is a kind of different way of dealing with that problem, but it also deals with a bunch of other problems.
okay.
Anything else? Okay, well, thank you very much.
Thank you.